So let's talk a little bit about First Republic Bank.
Yeah, so yesterday we brought you the pretty shocking news that we were living through the second largest bank failure in history. So that's kind of a big deal. And we now can bring you some more numbers about just how significant the turmoil in the banking sector of these past few months has really been. Put this up on the screen from the New York Times. They crunched the numbers and they found that the failed banks this year were actually bigger than 25 that crumbled back in 2008. And you can see it's pretty close. If you're looking at this bar chart, these three banks that just failed just barely, managed to surpass the 25 that failed last time around. They said the three banks held a total of $532 billion in assets. That's more than the $526 billion when adjusted for inflation held by the 25 banks that collapsed in 2008 at the height of the global financial crisis. You will recall the implosion of Washington Mutual that year, as well as the investment banks. Lehman Brothers, Bear Stearns was followed by failures throughout the banking system. And between 2008 and 2015, there were actually more than 500 federally insured banks that failed. Most of them were small or mid-sized regional banks, and most of them were absorbed into other institutions. Washington Mutual itself, which was heavily involved in risky mortgages and became the largest bank to fail in history, was sold to J.P. Morgan Chase, just as First Republic has now been sold to J.P. Morgan Chase, which has made this bank an absolute giant. It is now by far one of the largest banks in the entire world. Jamie Dimon, as we discussed yesterday, is like one of the most powerful people in the world now. Ever since we had the 2008 crash, banks have only gotten bigger and bigger and bigger. I think the number I saw is that J.P. Morgan Chase is now twice the size that it was before the crash happened. So the whole idea of we're going to end too big to fail, et cetera, didn't work out that way.
Yeah, too big to fail is now policy. I mean, I said this yesterday, but having the numbers is nuts. JP Morgan, $3.2 trillion, Bank of America, $2.42 trillion, Citibank, $1.77 trillion, Wells Fargo, $1.72 trillion. The drop-off from the big four down to the U.S. Bank is over $1 billion.
Huge.
From their point, you get to $500 billion. Then PNC Bank is $500 billion. Trust Bank, $546. Goldman, $487. Capital One, $453. And TD Bank, $387. So the reality is it's exponential, the growth, whenever it comes to the biggest banks in the U.S. And in effect, we really just have four banks, in this country that can control the vast majority of assets, which means that if any one of those four goes down, then you're looking at 2008 on steroids. And I just think that the headline there is something that we should all really internalize. The three failed banks, bigger than the 25 that crumbled in 2008. Now, we're not saying that this is 2008. It's not the same level of contagion. It's not the same level of systemic risk to the banking system. It's not going to have the same cascading effects. What we are showing you, though, is that the precarity within the economy is probably bigger than people think, and that we could just be one or two events away from a possible 2008 environment. And even if we're not, the system that we have right now, if '08 ever hits again, and do you really believe the regulators are totally doing their jobs? And if one of these big four goes down, one of these, the Bank of America's, the J.P. Morgan Chase, the Citibank, Wells Fargo, we have four guys who are in charge of those. If just one of them, 25% makes a decision, 1 in 4 chance. You could crash the entire U.S. economy. You could literally, and it would be bigger than 2008 in terms of the bailouts that would need to be done and in terms of the risk that it poses to all of us.
Yeah, no, that's right. There were a couple other pieces we wanted to bring you here. So part of the issue that we discussed extensively in the wake of Silicon Valley Bank collapsing is, what should be the FDIC in deposit insurance levels. $250K is in theory what it was, but when Silicon Valley Bank collapsed, instantly the government came in and said, no, we're actually going to backstop all deposits. So that raised a host of questions about, okay, well, you're doing that for everybody. What does that mean? Do we need to adjust the system going forward? And put this next piece up on the screen. The FDIC just issued their own report. This was written up in American Banker, a publication I frankly did not know exists, but do now. They say FDIC recommends higher deposit insurance for business accounts. So they considered 3 different approaches. One is unlimited deposit insurance, basically make what they did at Silicon Valley Bank, make that the law of the land and have premium increases to reflect the fact that actually now all deposits and all values are going to be backstopped by the federal government. They said that particular idea could be a bad idea because it could encourage sort of risky behavior on the part of banks and depositors, et cetera. They were worried about moral hazard there. I'm sure also the banks don't really want to pay those premiums.
No,
that would, create a fund large enough to be able to backstop the entire, deposits of the entire country. So that was one idea that they put off the table. The other is to keep the status quo, $250K for everybody, and it is what it is. They felt that because of some of the challenges that we saw with Silicon Valley Bank, that doesn't adequately address run risk. So they felt that that was not the best way to go. So the third way that they propose here is targeting deposit insurance for business accounts so that you could have greater coverage for business accounts without all the moral hazard unlimited insurance introduces, yielding what they describe as substantial financial stability benefits relative to their costs. So they're trying to say, okay, so for most regular depositors, it'll stay at $250K. For business accounts, they would presumably have to pay some sort of surcharge, and they would have a higher level, not unlimited, but a higher level of deposit threshold that would be covered.
Yeah, look, I definitely support that. You know
Makes
what the
sense.
problem is, though, is that when you give somebody something for free, then why are they going to pay for it? So imagine that. Like, we came out and said, hey, don't
That's a
worry
great
about
point.
it. All FDIC things are benefit. And everyone was like, okay, cool. So they got the benefit and they didn't have to pay for it. So why would they pay for it? And even if they do pay for it, we will all pay for it. They're the ones who are going to raise the rates because of their risky behavior. You know, there should be a better system that is put in place where the cost is not put on to the consumer or the small business, Krystal, somebody like your and my account, instead of something like the banks and their profits that they are allowed to take in the first place. So I think this whole system is totally backwards for who gets to pay and who doesn't. And it's just still highlights to me like how unfair the entire system really is through all of that. You know, also though, in terms of the Federal Reserve, at least some questions are being asked. Put this up there on the screen. Jerome Powell actually could face more opposition as these Fed choices are getting tougher. The Biden administration is set to nominate a new person to the overall governance board, Krystal. And at the very least, policymakers are asking questions about the interest rates. And
Yeah,
the way
now that their banker
thinking.
buddies are in
Yeah,
trouble,
exactly.
they're starting to think like, maybe we've done enough rate hikes.
Good point. Right. So anyway, at least they are doing something, but they're not doing something because any of us are suffering. It's because their bank boys are failing.
And they're still expecting to, they're meeting this week. The expectation is very much they'll move forward with a 25 basis point hike. And then after that, you have really split views. You have some what's called, hawks who want to continue hiking rates at a very aggressive clip, given the fact that inflation continues to be relatively high, although the pace has come down somewhat. And then you have some doves who are like, we've already kind of broken some pretty significant things in the economy by lifting the rates because the interest rate risk was at the core of the failure of all three of these very significant sized banks. So they're saying, listen, we already broke some stuff. Maybe we should cool it here and wait for things to settle and see how it's all going. So that will be a fight that's playing out at the Fed over the coming months. Hey guys, ready or not, 2024 is fully upon us now, and Saagar and I have been brainstorming ways that we can really up our game for this critical election.
Yeah, we rely on our premium subs to expand our coverage, to add staff, to upgrade the studio. We just want to give you the best independent coverage of this election, which is possible. So if you can help us out, become a premium subscriber today, breakingpoints.com, or the link is down here in the description video. It really means the world to us, and if you like what we're all about, this is the best possible way to keep us 100% independent, working only for you.